Good morning everyone and welcome back to Morning Markets here at True Potential. Today we're going to discuss in more detail the ramifications from yesterday's inflation print in the UK, the market impact and what it means for the Bank of England later today. So as was discussed yesterday, a surprisingly strong inflation print from the UK. More worryingly was the direction of core inflation. So this is the inflation measure which is more representative of actual demand in the economy, and it siphons out things like energy and food prices which can be more volatile. So clearly there are underlying building inflation pressures in the UK. So let's begin with the impact on the fixed income market, the bond market. So it's important to stress at this point that bond markets were actually well conditioned for a likely strong outcome given the prior inflation prints we've had in the UK, but also the wages data which has been growing as well. So markets had expected that there would be over 100 basis points of interest rate hikes ahead in the market. It's more likely that the Bank of England will be forced to accelerate their hikes beginning today. So relative to other markets, the UK now has higher yields than countries in the G7. What does that look like? Well, two-year yields in the UK on a gilt, a sovereign bond here, are now 0.31 percentage points above the equivalent in the US, and at the 10-year tenor, it's now 0.67 percentage points above the equivalent in the US. So that really means that the UK government is now having to pay more to borrow in the markets than its peers in the G7. Why is this of importance? Well, the UK runs a budget deficit, and as of last month, UK debt to GDP actually rose above 100%. So that is, our debt profile is now growing more quickly than our actual economic growth rate. And that places a greater burden on the taxpayer for paying the annual interest rate bill. So the UK economy does likely need some form of growth impulse going ahead with this inflation headwind. So the bond market took it relatively well, given it was already well conditioned for this. Equity market less so. Unsurprisingly, it was home builders which took most of the impact. Names like Taylor Wimpey and Persimmon were down around about 4%, and that's because markets expect it will be more difficult for these developers to sell existing units. They will likely have to revise their forecasts for future building, and there will also be a margin squeeze. So if we bring all that together, we're likely to see a re-acceleration in the Bank of England hiking path beginning today. They were hiking at 0.25 percentage points. That's likely to go up to 0.5 percentage points today, and they're likely to indicate a similar pace for the meetings in July and then towards the end of the summer. And that's all to try and get a grip of inflation and really ease these core measures down. So please join us tomorrow when my colleague Paul Durrans will update you on the Bank of England and their communication. Thank you.